The following presentation is a business and financial analysis of two publicly traded U.S.-based companies, Acuity Brands Inc. and Hubbell Incorporated. The presenters of this presentation are Joshua Louie, Shweta Trehan, Amy Vang, and myself, Christopher Wilkins. The analysis used data from FY 2018 and 2017. The presentation includes our rationale for selecting Hubbell Incorporated as the best company for investment purposes. Acuity Brands, the first company we will discuss, is a global manufacturer of lighting and building management products. They were founded in 2001, headquartered out of Atlanta, Georgia, and have over 13,000 employees. Under their parent company, they operate 41 subsidiaries and market their product under 25 unique brand names. Product and professional services are offered through independent agents, system integrators, electrical distributors, OEM channel, and from the company's direct sales representative. Their market capitalization is $5.1 billion. Their largest client base is the North American market, where they serve an estimated $20 billion of the $500+ billion industry marketplace. Their executive team consists of the chairman and CEO, Vernon Appel, the president, Richard Reeves, and the CFO, Karen Holcomb. In 2018, net sales were recorded at 5% growth, ending the fiscal year at $3.68 billion, with a net income of $349.6 million, representing a net income increase of 9%. Their total assets were reported at $2.9 billion, a 3% increase. Their liabilities were $1.2 billion, and stockholders' equity was $1.7 billion, an increase of 3%. The diluted earnings per share is $8.52. Since 2005, Acuity Brands have strengthened their position in the marketplace. Known for having a history of good returns on capital and strong free cash flow, Acuity Brands has made several notable acquisitions. Using cash on hand, a major acquisition was Distech Controls, a building automation system company. This acquisition was Acuity Brands' entry into the building and energy management market, and it enabled Acuity Brands to have a direct B2B sales channel with end clients, in lieu of the traditional agent or distributor sales model. The acquisitions have aligned with business drivers, including changes in environmental regulations, rising energy costs, and a client focus on using data to drive business decisions. Their strategy aligns with the industry's push toward building Internet of Things technology, which focused on connecting all the major components of the building together, such as the HVAC, lighting, and security system. The integration and connectivity of these components optimize building operations, reduce energy costs, and lower facilities operations and maintenance expense. Atris, Acuity Brand's new flagship software suite, encompasses IoT technology. Business challenges include high inventory turnover days, complex environmental regulations, an ongoing security class action lawsuit, and increased competition from cheaper agent importers. Aggressive pricing competition resulting in a 1.9% decrease in gross profit and a 2.4% decrease in operating profit. One of Acuity Brands' competitors, Hubbell Incorporated, will now be discussed by Joshua Louie.
This is Joshua Louie, and I will be covering Hubbell Incorporated, which is Acuity's competitor. Hubbell is an electrical products manufacturing company that provides products for both industrial and residential needs. The company was founded in 1888 and currently has a portfolio-style model with 81 different acquisitions and several of their own subsidiaries. Hubbell's product line varies and has expanded over the years. Hubbell has manufacturing plants in both the US and internationally. And as of 2018, Hubbell reported an increase of 22% in net sales and a revenue of $4.5 billion. The Industrial Revolution in the United States resulted in a huge influx of products being mass-produced in factories. Due to an increase in the number of factories opening, the market opened for an opportunity for new products to be introduced to support the new factories. Hubbell entered the market with their pull chain lamp socket, of which I've included a diagram on the slide. Hubbell's go-to strategy of approaching the market is through acquisition-style approach. to build this portfolio. A couple of key recent acquisitions that has put Hubbell in its current marketplace include the 2007 acquisition of Pcor, which is a company that creates products that can carry electricity up to 500,000 volts. This acquisition put Hubbell into the industrial market. The 2017 acquisition of iDevice. iDevice is a company that provides the interface for a majority of smart home controls. This acquisition put Hubbell into the smart home market. And finally, the most recent acquisition in 2018 of Aclara, which is a smart infrastructure solution company for electricity, gas, and water companies. This acquisition put Hubbell into the automated technology market. Hubbell's key drivers continue to be the creation of new tools and methods within their 5 areas of service, which include non-residential, electrical transmission and distribution, industrial, oil and gas, and residential, and their 4 types of products, which include lighting and control, wiring and electricity, power and utilities, and data communication. This variety has allowed Hubbell to create a plethora of products. The key challenge that Hubbell faces is that they are heavily dependent on the economic and political well-being of their international partners' political and economic well-being standings. 1/3 of Hubbell's products are sourced or manufactured outside of the United States. When comparing Acuity and Hubbell's position in the market, expectations, and Wall Street's positions, the 2 companies are relatively similar. The difference lies in their marketing strategy. Acuity's go-to marketing strategy is to expand into the smart home market. As of 2018, Acuity has $461 million in cash on hand, and this is after the repurchasing of shares, capital expenditures, and dividends, and so they're set up to continue that expansion. Hubbell, on the other hand, takes a more varied approach and focuses on market needs and shifts their products around to meet that need. Hubbell is expected to be financially stable going into the rest of the fiscal year. As for Wall Street's position on Acuity, Wall Street expects a decline in stock price due to common shares fluctuating significantly, and these fluctuations may be due to non-performance related issues, reports by an industry analyst, and any negative perception from investors or consumers. However, although there is a decline in the share price but a growth in the earnings per share, it doesn't necessarily mean that Acuity is doing poorly. Hubbell, on the other hand, due to strong performance, Wall Street predicts a steady growth in share prices and earnings per share over time. Being competitors, both Acuity and Hubbell focus on increasing revenues and growing their presence in the market. However, Acuity uses future net sales and short-term growth rates to make financial forecasts regarding their next step. As a result, Acuity looks to see where the market is growing and joins in. Hubbell, on the other hand, approaches by focusing on the innovation of products and improving current operations to maximize return on investment and minimize rising material costs. In doing so, Hubbell builds a strong brand name and a varied product line. In terms of risk, both companies face acquisitions with low return on investment value and varying degrees of dependence on the global economic and political climate. Now, Amy will start the financial analysis.
This is Amy, and I'm excited to dig deeper into the financial analysis. To kick it off, we'll start with the executive compensation structure. Acuity Brands allows stockholders an opportunity to vote on an advisory basis to approve compensation of all executives. All shareholders vote based on the amount of common stock that they hold. The CEO compensation for 2018 was $2.4 million, inclusive of stock and awards. The reported 2018 compensation for the CEO of Hubbell was $7.6 million, inclusive of stock and awards. It's interesting to note that the CEO compensation for Hubbell has decreased since 2016, while most other executives have increased. We've also included points in the tables regarding the executive compensation governance practices between Acuity and Hubbell to comply with for reference. Next, we're going to cover the earnings call summary. Acuity Brands completed their Q4 2019 earnings call on August 31st. Overall, there was a rise in earnings, but net sales decreased by 12% year over year. Vernon Nagel, the CEO, mentioned 2019 was one of the most challenging years we've experienced at Acuity. The markets we serve were in a constant state of flux throughout much of the year. Inflationary pressures at the beginning of the year were exacerbated by the number of market shocks, including the addition of significant tariffs based on Chinese-made components and finished goods, uncertainty created by the threat of further trade actions, and labor shortages in the key market. These issues and more created great economic uncertainty, tempering demand for lighting products in both the residential and non-residential construction markets, end quote. EPS did grow at 2.6%. On the commercial side, Acuity found success in connecting lighting Atrius-enabled solutions, and also during the call, key leaders highlighted the acquisition of Luminaires Group. Hubbell finished their earnings call for Q3 during October 29th. Leaders had confidence in meeting investors and analyst expectations. In Q3, they had a raise of 3% year-over-year growth. Full-year EPS expectations grew from $7.95 to $8.10 based on year-to-date results, showing a 1.9% increase. Expectations raised for a full-year free cash flow conversion to more than 100% of adjusted net income based on our results through the 9 months and expectations into the fourth quarter with operation efficiency strategies. Next, onto the horizontal analysis. The below chart shows a horizontal analysis of Acuity brands, and it shows minor changes in the figures that have improved from its previous years, while the negative figures have greater margins of decrease. The provisions for income tax has shown the maximum decline by 55%, followed by irregular income expenses having dropped by 50%. The business revenue and cost of goods and services have shown minor positive improvements, and the gross profit has had no change. This chart shows the horizontal analysis over the last 2 years for Acuity brands for reference regarding the horizontal analysis for the income statement. The below table for the horizontal analysis of Hubbell Incorporated shows the irregular income expenses for this company is worse compared to that of Acuity brands, as it has decreased by 100% from the previous years. However, there are certain positive and improvements like the preferred stock contributions, which has increased by 63%, and the net income for common stockholders has also increased by 48%, which is a sign of improvement and satisfied shareholders. The net investment income and net income for minority interest of the company has also risen by 48%. This chart showcases the horizontal analysis over the 2 years for Hubbell for reference regarding the horizontal analysis for the income statement. The asset of Acuity brands mostly seem to be lower than the position of Hubbell and its competitors. The assets of Hubbell are higher in position, while the assets for Acuity brand have certain negative figures. The total assets for Acuity brands increased by 3%, whereas Hubbell increase was for 31%. The total current assets for Acuity brands decreased, while for Hubbell, it increased by a small margin. The non-current assets for Acuity brands shows the increase was only 7%, whereas Hubbell showed a 53% increase. This table shows the total assets analysis of both companies and a side-by-side horizontal analysis comparison. I'd like to note a few focus on the percent changes between each company based on the previous 2 years, which has been a highlight in analysis for both companies. The liabilities for Acuity brands have mostly seemed to be lower than the positions of Hubbell to its competitors. The liabilities of Hubbell are in higher positions, while the liabilities for Acuity brands are in lower positions. The total liabilities for Acuity brands increased by 3%, whereas Hubbell Incorporated was increased by 48%. Total current liabilities for Acuity brands decreased, while Hubbell Incorporated increased by a small margin. The non-current assets for Acuity brands showed a decrease of negative 7%, whereas for Hubbell, the increase was for 63%. Here we've broken down a side-by-side analysis of total liabilities within the last 2 years for both companies. In conclusion, we've broken down key focuses on the income statement, balance sheet assets, and liabilities for both companies, which has helped our decision-making process for the financial analysis. Without further ado, I'd like to pass it over to Shweta.
Hello, everyone. In the next few slides, I will be presenting the vertical analysis of the income statement and balance sheet for Acuity brands and Hubbell Incorporated for the years 2017 and 2018. In this slide, we have presented some of the key highlights of the vertical analysis of the common size income statement for the years 2017 and 2018 for Acuity brand. This slide displays the common size income statement for the Acuity brand for the years 2017 and 18 for comparison. In this table, we have expressed the different income statement accounts as a percentage of total sales. Some of the year-over-year key highlights are the gross profit as a percentage of total sales went down from 42% to 40%. The net income from continued operations remained at 9% of total sales. The normalized operating profit reduced from 17% to 14% as a percentage of total sales. Last but not the least, operating income/expenses went up slightly from 27% to 28% as a percentage of total sales. In this slide, we've presented some of the key highlights of the vertical analysis of common size income statement for the years 2017 and 18 for Hubbell Incorporated. This slide displays the common size income statement for Hubbell Incorporated and also shows the comparison for years 2017 and 2018. In this table, we have expressed the different income statement accounts as a percentage of total sales. Some of the year-over-year highlights here are gross profit as a percentage of total sales went down from 31% to 29%. Net income from continued operations went slightly up from 7% to 8%. Normalized operating profit reduced slightly from 15% to 14% as a percentage of total sales. Last but not the least, operating income/expenses went down slightly from 18% to 17% as a percentage of total sales. In this slide, we present the highlights of the vertical analysis comparison of the balance sheet with total assets as a denominator to evaluate various asset accounts of the balance sheets as a percentage of total assets. This slide displays a common size balance sheet statement showing the asset accounts for both Equity and Hubbell Incorporated for the years 2017 and 2018 side by side. Some of the year-over-year highlight are the total current assets as a percentage of total assets decreased by 2.5% for Equity and by 10% for Hubbell. The total non-current assets as a percentage of total assets increased by 2.5% for Equity and 10% for Hubbell. Here we present the highlights of the vertical analysis comparison of the balance sheet with total liabilities as a denominator to evaluate various liability accounts of the balance sheet as a percentage of total liabilities. This slide displays the common size balance sheet statement showing the liability accounts for both Equity and Hubbell Incorporated for the years 2017 and 2018. Some of the year-over-year highlights are the total current liabilities as a percentage of total liabilities increased by 5% for Equity and decreased by 7% for Hubbell. The total non-current liabilities as a percentage of total liabilities decreased by 5% for Equity and increased by 7% for Hubbell. Here, we conclude the vertical analysis with the vertical analysis chart that visually highlights the vertical analysis of the income statement and balance sheet for the two companies side by side. Last but not the least, this slide displays the key financial ratios representing their profitability, liquidity, and solvency of the two companies side by side. The profitability ratio highlights that Equity brands have greater values as compared to Hubbell due to high profit margins and sales revenue. The liquidity ratio increases for Hubbell Incorporated due to the increased account receivables and cost of goods sold. The solvency ratio for Hubbell Incorporated are higher due to the higher total liabilities and assets. Based on the vertical analysis and the horizontal analysis and the financial ratios, now Chris will be concluding our presentation.
Thanks, Shweta. The information you and the team just presented, such as the return on shareholders' equity, the gross profit margin, and the solvency ratio, played a major role in our team's ability to decide whether to invest or lend. Our approach looked at both companies from an investor and creditor perspective. Our group conclusion is that as an investor, we will hold on the Acuity brand and invest in Hubbell. Hubbell have increased their year-over-year earnings and had greater success in generating revenue. Hubbell's profit to earning ratio indicate that Hubbell is currently undervalued while Acuity brand is at a near fair value. We predict that an investment early Q1 of 2020 will yield the best return. As a creditor, we decided not to lend to either company. As previously shown, the Acuity brand has better leverage with their gross profit and the pending security class action lawsuit. pose a risk. Hubbell also experienced low gross profit margin, and their debt-to-asset ratio is high. As previously shown, their debt-to-asset ratio is 0.63, and we would expect the ratio to be closer to 0.5 for lending purposes.